3 weeks ago today, we asked this question. And since then, we've been slapped in the face by a US stock market crash which fell harder and faster than even the 1929 version. As you well know, we have a growing pandemic that has increasingly shut down economic activity across the world, requiring a resetting of virtually all prices and values still ongoing. Add to that, a supposed oil price war has broken out, which may be a clear signpost to the end of the fiat petrodollar era. More on that in a bit. Hello, this is James Anderson speaking on behalf of sdbullion.com. Precious metals and speculators betting long in the COMEX and NYMEX price discovery markets were also taken to the woodshed this week. Gold held up best in value, and shortly in this video, we're going to drill into historic levels of gold value appreciations we may be revisiting again. The spot price of silver finally fully rolled over in the face of this deflation and deleveraging. The gold-silver ratio is now around 104, and we'll put that into historic context later this episode. The same deflationary spot price beatdowns occurred this week too, with both platinum and once record price parabolic setting palladium. Amazingly, on paper at the moment, the gold-platinum ratio is now over 2. Just yesterday, we had a stock sell-off about 10% in one day, and that was second only to Black Monday in October 1987, when the S&P 500 lost 22% of its value in one day. Today, we had a stock market rebound of up over 9%. This kind of day-to-day volatility is not the typical sign of a healthy financial or equity market. Demographic and fundamental factors are a lot different now than they were back in 1987. Yet still, some hopeful stock rebound bulls think the private central bank and federal government will create and inject more trillions of fiat Fed notes, driving our return back to all-time nominal highs within a year or two perhaps. As fallible human beings, it typically takes about 3 generations or roughly 90 to 100 years of time for most of us to forget big and even small lessons of our forefathers. The last time we had a pandemic on this scale was the Spanish flu around 1920, and that lasted for some 2 years of time and came in 2 waves, killing millions across the world. Just yesterday, macro analyst and founder of Real Vision, Raoul Pal, was on Yahoo Finance discussing downside potentials to come. Now, this video clip is not meant to scare you, it's merely to remind us all that this could last longer than many of us think is even possible.
Impact of the coronavirus. A bit more with Raoul Pal, CEO and co-founder of Real Vision and founder of Global Macro Insider. We also want to bring in the panel for the next hour. We have Yahoo Finance's Julia LaRoche and Chris Whalen, Whalen Global Advisors Chairman. Raoul, I mean, on a day like today, a lot of people weren't investing. I'm thinking of millennials who might have been youngsters or at least in college, not necessarily investing. The last time we experienced these kinds of this volatility in the markets, here we are, not a financial crisis, not yet, but we're watching dramatic downs. And what advice do you have to people who were not prepared, may not have been balanced or diversified going into this? They were long equities and now they got caught.
The question is how big an event is this? And this is the thing that everybody's grappling to try and understand. Because if it's, as the president suggests, it's going to bounce back and everything's fine, then everyone should just hold on and continue to, invest in their 401ks. However, if the reality is something different, which is what I think it is, which I think this is actually possibly the biggest economic event of all of our lifetimes, then there's chances that the market falls further over time. Obviously, there'll be periods where it bounces, but as you're seeing a rolling shutdown of global economies, we have literally never seen a demand and a supply shock like this before. So I would urge people to be cautious. Now, if you're young, then having cheap prices over time means that you can average in over time into your investments, and that's a good thing. It's less good for people who are closer to retirement age.
Raoul, it's Julia LaRoche. You just mentioned that this might be the largest economic event of our lifetimes. You're someone that extrapolates probabilities. Unpack that for us. What are you looking at? What should investors, even our audience, our retail investor audience, be paying attention to?
Look, we haven't got much economic data, so you have to kind of join the dots. The only real economic data we got were the PMIs out of China, and that was a while ago now, while China had shut down its economy, and that was probably the weakest piece of economic data I've ever seen in history. I mean, that's how bad it was. So China entirely shut down. That's the world's second largest economy, the world's largest exporter. Now, people initially extrapolated that it was just a China problem. And South Korea then struggled, Singapore and a few other countries, but they did a great job. What happened was the spread into Italy and now across Europe and into the US, that something worse. So Italy, as of last night, pretty much closed every single business in Italy. There is going to be very soon zero economic output from Italy of any meaningful note, meaning factories won't be able to produce goods, people won't be able to consume anything. So that is the worst case scenario we've ever seen. Because even in wartime, there is demand for things and there is supply of things. So it is really strong when a whole country closes, not only its borders, stops its people moving, and then puts them at home so they can't spend money, they can't go to work, they can't create the productivity that drives economies.
Raul, I just wanted to mention, we've sort of bounced a little bit off the lows, but it looks like we are still potentially on track with the Dow for the worst day since the crash of 1987. So the scenario that you're describing, the scenarios that we've seen around the globe, particularly in Italy, though, is that what's being priced in at these levels? We're getting this sort of death by 1,000 cuts at this point in terms of closures, the drip of closures. Are we going to see a more universal shutdown of operations in the United States? And is that what stocks are anticipating?
So if you think of it in historical terms, usually a recession would see the stock market down between 30 and 50%, 30 and 40%, let's say. In a bad recession like 2008, you tend to have 40 to 60% declines. And in a depression, it's 60 to 80% declines. So where are we now? We're basically 20% off the highs, or maybe just a bit over that. So we're barely pricing in a mild recession. So that makes me think that the potential is much worse, because for me, it already looks like it's going to end up being worse than 2008 in economic terms. We'll talk about financial terms later. So therefore, I don't think it's priced in. The other difficulty here is when you have so many unknowns, how bad is the virus in the US? What is the scope of the closures of the US that we're going to have to see? And then the most crucial thing of all is what happens over the summer. The markets have a hope that the virus diminishes over the summer and maybe dies off, like SARS did. But studies seem to suggest that's not going to be the case. We just don't know. So the market has to grapple with the possibility that it comes back later in the summer with a vengeance, much like the Spanish flu did. And so that unknown probability creates so much uncertainty for the markets that it's impossible to price. Hence why the market's kind of in free fall, trying to find some place to stop to say, OK, we've now caught up with reality, and now we need to see what develops. And I think that reality is lower down in the markets than here still.
Raul, this is Chris Whalen. Great to see you.
Hey,
Don't
Chris.
you think that we're going to have to abandon this lockdown model in a matter of weeks, because the ill effect of shutting down economies may be actually worse than the impact of the virus itself? I mean, what are your thoughts on that?
I think, I know it's a school of thought. My thought is, if I extrapolate the rate of spread, the RO of the coronavirus, and its death rate that we understand it to be, it moves around a bit, and impose that on the kind of size of the event the Spanish flu was, which was basically an unconstrained virus pandemic, we would affect about 27% of the world's population and kill 68 million people. Now, that is not something almost any politician or economy is prepared to do. Secondly, this is sort of like a nuclear weapon for the baby boom generation that owns all the assets and is the majority of voters still. Now, most of the voters and most of the politicians are baby boomers, and that means that they are over the age of about 60 years old, and that is where the death rates become higher. They come up to 10% or so. So I think it is almost impossible for any government to try the unconstrained approach. The objective here is to shorten that bell curve, which goes very very high into the peak, as China did, comes down the other side as you close down an economy. They're going to try and flatten it out. If they don't flatten it out, I think the loss of life is too much. And also we're seeing in Italy, the effect on the healthcare system is too much for anybody to cope with.
This past weekend, a supposed price war in oil broke out, and the gold-oil ratio was driven to new all-time full-fiat petrodollar system highs. The battle appears to be between the Russian Federation, Saudi Arabia, and U.S. shale oil frackers. The price per barrel of WTI crude oil is now in the low 30s, and questions remain not merely regarding possible U.S. shale oil bailouts, but more so questions regarding geopolitical strategies here, and regarding gold's upcoming role in the future. In the fullness of our nation's history during deflationary eras, following when silver was demonetized, the gold-oil ratio rose to nearly 100. It's hard to know how much higher this ratio might go now that we, apparently, and not foreign governments, are busy buying our escalating IOUs. Regarding gold's strength of late, it's questionable how much higher this gold-silver ratio may run to. The all-time record high for the gold-silver ratio occurred in 1933 when the gold-silver ratio reached 134, as freshly confiscated gold got rigged to 35 per ounce, and silver was only a penny higher than its all-time low-level price at a mere 26 cents per troy ounce. The current gold-silver ratio is roughly 104. The U.S. Mint is now temporarily sold out of Silver Eagle coins. The most popular silver bullion coins in the world have temporarily sold out, and the U.S. Mint citing rates of sales that have exceeded 3 times what was sold last month as the main reason. And while we here at SD Bullion still have bullion supplies on our shelves, product premiums are escalating due to supply constraints versus outsized demand at the moment. What is past is likely indeed prologue for precious metals. Like the fall of 2008, this industry is typically not able to handle demand increases of 5 to 10 times for long durations. This industry has also suffered many silver and gold refinery bankruptcies over the last few years, and that's exacerbated ongoing supply constraints. If spot prices stay or perhaps lower in the weeks to come, you can expect more delivery delays and product sellouts. For now, our team at SD Bullion is working 7 days a week, processing and shipping out hundreds and thousands of customer orders each and every day. To finish this week, we're going to again hear recent thoughts from billionaire bond trader Scott Minerd, who yesterday was speaking with CNBC, specifically on the Federal Reserve and the federal government bailouts to come. While late this week, the Federal Reserve upped their seemingly ever-expanding overnight repo operations to trillions of daily aggregate loans with multi-month long durations, the U.S. Treasury head is now using terms like unlimited liquidity. Have a listen to billionaire silver bull Scott Minerd, what he thinks is coming our way.
Well, let's get more now on the reaction to the Fed's big move, the markets, the credit markets, and everything else. So we are pleased to be joined by Scott Minerd, Chief Global Investment Officer at Guggenheim Partners. Remember, on February 13th with us, he said that we were in, quote, ludicrous season. The S&P would peak on, it turned out, peaking on the 19th. Last week, he said the 10-year could fall to just 0.25%. No doubt mocked for that. But we had the 10-year hit 0.38 shortly after that, rebounding a little bit in the past few sessions. Scott, welcome. I know you're busy. Thanks for taking some time out for us here on CNBC. Was there anything that, I called it a Fed fail at the top, and maybe that's right or wrong. Was there anything that you saw in the credit markets that indicated to you that things were loosening up?
You mean in terms of improving, Brian?
Yes.
No. It's very situational right now. There are many securities that you really can't get bids for. The liquidity in the market is, I think we're in what would classically be a Nash equilibrium problem. That is that the market has been held up artificially. And there are sellers who'd like to get out, but the buyers who are willing to get in are at much lower levels. And so I think in the credit markets we will see a sudden and precipitous collapse in prices.
Okay, well, Scott, what does that mean, a sudden and precipitous collapse? I'm looking at some of these closed-end funds. I'm looking at some of the high-yield ETFs, looking at some of the debt that I can, and a lot of it is already down 20 and 30 and 40%.
Right, but those are interesting, Brian. Those funds have more liquidity to them. than the underlying markets. So, for instance, a closed-end fund today in high yield might be down 3%, but I've seen stuff trade down 15 to 20% in the closed-end fund market. Now, you could say that's panic, and yes, I think it is, but it's also showing you the lack of liquidity. In the institutional world, institutions tend to have a little bit more flexibility. They don't have to sell a security as opposed to in the more liquid markets like the stock market, where a specialist has to make a bid every day and there's always a seller. So I think that we haven't really seen prices marked down in selected asset categories. Probably the most vulnerable, high yield and bank loans are still vulnerable, but right now in terms of having true price discovery, I think asset-backed securities, CLOs, whole business securitization, aircraft, those are the most vulnerable places.
And I'll let everybody else jump in here for a second, but I want to ask you one more. We talked about it, QE, Scott. Obviously, I'm going back to 08 and 09, TARP, TALF, some of these programs. Would you describe what the Fed did as those, and if not, do you think that we're going to need a return to those types of direct buying programs?
Well, let's talk first. There's a number of things you're bringing up there, Brian. There's quantitative easing. I've always argued that Treasury bill purchases were QE. Now there's no argument anymore because they're buying across the yield curve just like they did with QE. The Treasury bills that are maturing will get reinvested across the yield curve just like QE. So, we've definitely engaged in quantitative easing. Our view is that if we are not already in a recession, we will slip into one very soon. And the analysis that we've done shows that it will probably take about $4.5 trillion worth of asset purchases in order to stabilize the economy. On the TARP side, TARP is a creation of Congress. I think that that would be the appropriate thing right now. One thing I'd like to remind the policymakers when I talk to them is TARP was a money-making opportunity. And if done correctly, it can be a money-making opportunity again. But I think the TARP program here would probably have to be more like $2 trillion versus the sort of $700 billion that we did in the last downturn. Mm-hmm. And TALF, if we have TARP, then we can do TALF. And TALF would be a great idea to provide financing for illiquid assets for people like me who manage client money because you can't get you can't get financing to lever your positions, and a lot of investors like hedge funds like to lever their positions.
Scott, over the fall, in the fall, we talked about there was huge volatility in the bond market, and we're talking about 10-year yields. Over the course of the last week, and Brian just alluded to this, we've seen 10-year yields go from, I think, 35 or so basis points to where they currently are today, 80-something basis points. When, if you think about that, that is an astronomical move. And then you've seen 30-year go from 1%. So I think they close at 1.4%. I mean, one of the mandates, and I'm air quoting, you don't see me, of the Federal Reserve is price stability. Well, guess what? There is zero stability in the bond market, and the volatility in the bond market is at levels where it should never even be close to. What does that mean?
Well, Guy, I think what it's telling you is that there's a high degree of illiquidity, even in the Treasury market. There's a high degree of uncertainty. As people come in and try to, do purchases of Treasuries, the bid-offer spread has widened quite a bit. An off-the-run 30-year bond, for instance, that is the bond that was the long bond just a few months ago. Yesterday, we were getting quotes that had a bid-offer spread of 1 point. That's the sort of bid-offer spread that you would normally see in junk bonds. As for the movements, I mean, they're mind-numbing. Now, a couple of days ago, we had the 30-year bond go up in price by 7%. If we came in and the stock market were up by 7%, people would be stunned. And bonds are the low risk, supposed to be low volatility, low risk. So, it's definitely telling you that it's chaotic. People are probably overexposed on certain asset classes that they shouldn't be. And, we have a big dislocation here.
Hey, Scott, it's Tim. Again, thanks for joining us. One of the things that seems different about 2008, and this isn't a financial crisis, and we've talked about that. So I just want to talk about the duration of clarity. We had assets that bubbled to the surface, dead assets that bubbled to the surface. We had TARP, we had TALF. This all happened within about a 2.5-month span, at least when we got to the climax of it and the begin to repair. The current issue with the coronavirus is one that what we understand is we probably won't totally understand the impact socially, therefore economically, and in terms of the stoppages for almost 2 months. How does this make that recovery process and this policy process and this market kind of dynamic get worse, frankly? This is what troubles me.
Well, the first thing I would say, Tim, is that we're not in front of this. The policies that were proposed last night by the president are not adequate to address the problem. The scale of what they're attempting is not adequate to address the problem. And, as we see, Major League Baseball cancel its season, we see Disneyland closing. I joked today, I said, we're not going to have anywhere to go to spend any money anyway, which means the economic damage here is going to be much larger than people anticipated.
Let me ask you that.
Hey, Scott, it's Brian Kelly. So you were talking about how much stimulus might be needed and that we might already be in a recession. And by my count, I think you came up with somewhere around $6 trillion. And that seems like a pretty big package. So my question is, if we are in recession, how deep of a recession do you think we're looking at? And how long do you think we're looking at one for?
Well, those are great questions. I mean, typically a recession lasts about 18 months. There's a period here where we're going to have a sharp contraction in consumption if for no other reason we don't have anywhere to go to consume. Consumption is the biggest driver in GDP. So, we could see, a drawdown in economic growth in the second quarter that's the same as the drawdown in economic growth that we saw during the financial crisis. So, I would anticipate that. The problem is once you do damage to the economy, even if the coronavirus goes away, the weakening of the structures of the economy, such as the airlines and other businesses, is going to have a permanent impact, or let's say a prolonged impact, on the behavior of the consumer and the business. And so it's going to take a while to rebuild that confidence. So I really don't see us, having this thing turn around very fast. And that's one of the reasons why I may be a bit more bearish on stocks than some other people.
So Scott, just talking about the last two recessions, the S&P 500 basically got cut in half from the highs in 2007 to the lows in 2009, from the highs in 2000 to the lows in 02, 03. Given all the uncertainty right now, I mean, is that what we should be expecting here? That we're going to see the S&P 500 at half of the 3,400 that it traded at on February 19th? And then the other part of that question is, think about both times we had those recessions and think about where interest rates were, where Fed funds were, where the Fed balance sheet was. Is it going to be different this time? Does it have the potential to last much longer?
Well, look, I think I was on the show a month ago with some of the cast of characters we're on today with, and I said that I thought stocks could ultimately be 40 to 50% lower than their peak. So, I mean, we're playing this thing out exactly as I had expected. In terms of the size of the stimulus, I think that reflects the fact that we don't have a lot of tools here. If interest rates were at a higher level, or if that we had other structural forces in place, it could help us. But the reality is that it's going to take a lot of liquidity from the Federal Reserve if the policymakers do what they did in the crisis, which was lean on them, and it's going to take a large bailout of some kind, or I want to say a large support package from the government, because corporations today are so much more highly levered than they were at the time of the financial crisis, and they're much more fragile.
But companies are, Scott, but not the banks in the same way as 2007, correct? I mean, you don't see any chance of this becoming a banking crisis, do you?
No, I don't think so, Brian. I mean, obviously, if we have a wave of corporate defaults, which I expect, credit conditions will tighten. That is, it'll be harder for businesses to get bank lines and bank revolvers. But the more important component of financing is the bond market. And, we've already got the bond market shut down. It's virtually impossible to do a new issue, even for the highest quality borrowers. And, until we get some confidence back into the market, we basically have no access to debt or capital. But, the only reason people are going to be looking for capital is to cover negative cash flow. And the market's not going to look kindly upon that.
That's it for this week. Thanks for coming by. Take care out there. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on. Have a great day, everyone.